Welcome to today's video, where we tackle a common financial dilemma. Should you pay off your mortgage early or invest the extra money instead? In this video, we'll cover the core idea of this financial debate, offer a simple explanation, delve into key points, explore scenarios when early repayment makes sense, and finally conclude with personalized recommendations. Before diving into the details, let's briefly discuss the core idea underpinning this debate. Imagine you're borrowing money with a mortgage at a certain interest rate. The conventional advice here is that you should avoid paying extra on your mortgage, even if the interest rates are somewhat high, above 5%. To put it simply, if you can invest money and earn a higher return rate than your mortgage interest rate, it makes financial sense to invest. For instance, if your mortgage costs you 5% per annum in interest, and you estimate that the stock market can yield about 7% on average over the long term, then you are effectively making more money by investing rather than using the extra cash to tip onto your mortgage bill. Now we will move on to some key points that you need to consider when thinking about this decision. These points will help you weigh the advantages and disadvantages of each option. The debate essentially revolves around whether you should prioritize paying down your mortgage debt or investing that cash elsewhere. Resources such as bogleheads.org and similar forums offer valuable guidance in this area. Consider viewing your mortgage as renting a tool. If your house's value as a tool exceeds its rental cost or interest, it can often be wise to maintain it. Let's assess these additional angles. Opportunity cost arises from missing potential investment gains if you pay off your mortgage early. Investments, while risky involving market volatility, often promise higher returns over time compared to saving on the mortgage interest. By choosing to pay down the mortgage early, your funds become less liquid, as they are tied up in real estate, making it hard to access cash when needed. Moreover, inflation can reduce the real value of mortgage payments, and certain tax benefits may lower the effective interest rate on your mortgage. It's quiz time. Let's test your understanding. What factors should influence your decision to pay off your mortgage early? Option 1. Interest rates and potential investment returns. Option 2. Personal circumstances and risk tolerance. Option 3. Availability of other high-interest debt. Option 4. All of the above. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is all of the above. All the factors mentioned, such as interest rates, potential returns from investments, personal circumstances, and the presence of other high-interest debts are crucial in deciding whether or not to pay off your mortgage early. Let's talk about when it makes sense to consider early repayment of your mortgage. If you possess any high-interest debt elsewhere, prioritize settling that first. When mortgage rates are unusually high, it might be wise to consider early repayment. Additionally, some individuals find psychological comfort and security in living debt-free, so if that aligns with your mental well-being, it could justify prioritizing mortgage repayment. As we conclude, always evaluate your financial circumstances thoroughly, weigh the potential returns of investment against the cost of your mortgage, and make your decision in alignment with your personal risk tolerance and financial ambitions. Thanks for joining us in this financial exploration. If you enjoyed this video or found it useful, please go ahead and like, share, subscribe, and don't forget to drop your thoughts in the comments below.